Hi, I'm Rick Kaler. Thanks for joining me. Typically, I view insurance not as an investment, but a tool to protect assets or replace income. However, investing in one type of insurance, which is called reinsurance, is becoming increasingly popular. It even might be considered its own asset class. And let me explain why. Catastrophe reinsurance is purchased by insurance companies to help cover the cost of payouts due to natural disasters like storms, floods, earthquakes, and wildfires. Reinsurance investors absorb an insurance company's losses when these losses exceed a certain cap. So this helps the insurance company manage its exposure to catastrophic risks while being able to write more business. They know what their losses will be. It's like a deductible for them on an insurance policy. For investors, catastrophe reinsurance profits are not tied to the economy, and this is really key. They're not tied to interest rates, business cycles, or politics. They're tied only to natural disasters. So this lack of correlation to normal financial market influences is what makes reinsurance an attractive asset class. Investors in catastrophe reinsurance make money in two ways. The first is by making short-term deals to protect an insurance company through aptly named catastrophe bonds, called cat bonds. Now, unlike corporate bonds, the money must sit in T-bills in a trust rather than being used by the insurance company. And the principal, and this is really key, the principal does not have to be repaid by the insurance company if the company's natural disaster losses exceed certain thresholds. Now, for this risk, the bondholder receives an interest rate that can be 3 or 4 times the market rate of corporate bonds. Successful cat bond investors make money on the yields being higher than the long-term loss rate and relying on diversification and an index-like approach to manage the unnecessary losses. So since 2002, the cat bond market has had no down years and an average return of 6.2%. That's kind of attractive. The second way that investors can make money in reinsurance is by sharing a slice of the reinsurer's risk quota share contract called quota shares. So what that means is investors may take 10% of the risk of a natural disaster and in turn receive 10% of the premium from a pool of reinsurance contracts. The investor and the reinsurer make money by investing the premiums and on successful underwriting, right? Meaning you make more on the premium income than on the losses, than on the claims. Since 1993, quota shares have shown 5 years of losses and 22 years of gain, with an average return almost double cat bonds of about 11.2%. There's also a little more risk with the quota shares. The reinsurance business itself kind of has a reputation as being boring and sleepy. It makes money on two things: good underwriting and yields on investments. This asset class isn't suited for hedge funds or private equity looking for fast money. Remember, it's boring and sleepy. You might wonder why, in this time of climate change, anyone would want to insure property against natural disasters. This is the first thing that came to mind when I began investigating this asset class a couple of years ago. Now, this is really important. All politics aside, those in the industry tell me that the anticipated increases in frequency of hurricanes from climate change simply have not developed. Greg Richardson of TransRe, speaking at a recent conference on reinsurance hosted by Stone Ridge, told us that in the past 150 years, there is no increase in hurricane frequency, and that climate change isn't even in the top 5 hurricane risk factors. Now, what is true is that the financial damage caused by hurricanes and wildfires is steadily increasing. This is mostly because of higher values and increased building nearer the sea, rivers, and forests. So these industry insiders say that the media hype on climate change is actually helping to drive up rates on property insurance, which actually bolsters profits. I found this very, very interesting. The potential benefits then of investing in reinsurance are 3. Diversification. Stocks, bonds, real estate, commodities, and politics don't cause natural disasters. This is really important to internalize. The second one is adaptation. Premiums increase and underwriting tightens to adapt to risks. So it's not a one and done. And we know this. I live in Rapid City, South Dakota, that every 2 years, I think a hailstorm takes out my roof. Premiums are continuing to go up. There's companies that drop out of our market. They adjust because the insurance company must make a profit, and they have the flexibility to increase underwriting, to say we're not going to insure certain type of roofs, or we're only going to pay 50% of the damage, or whatever it is. They can adapt to the changing dynamics of any market that they insure. The third one is profitability. As I said, reinsurers must make money, or the coverage won't exist for the insurers to expand or share their risk. So profitability is really important. There's one final, I'll call it a feel-good benefit to investing in reinsurance as a part of a diversified portfolio. It's the only asset class where your investment losses go to help people rebuild after a natural disaster. All right, thanks for joining me, and see you next week.